Hello again, welcome back. Taking a look at the subscriber suggested company again, and actually one of my personal favorites, United States Steel Corporation, a company that I have used many times in the past to make some good amounts of money, and lately I pocketed quite some nice dough back from my recent play. I'm gonna explain all about it. I have talked about it in previous videos again as well in the past, but this one is gonna be dedicated to X, United Steel. And in case you're not a Patreon, if you become one, you can get access to this tool and follow through, create your own projections and everything. You can find links in the description box below, of course, but you can also follow through the video, and we're gonna talk about X here and what is going on with this company. Now, this is a company that is a cyclical company. It's a sector that has to do with steel, and steel is a cyclical sector. It is a sector that has to do with what the economy is doing, and so steel is not gonna be, it's not going to be a product that is going to be selling the same all year long. It really depends on how the markets are doing. It sort of like has its ups and downs, and these kinds of commodities tend to have ups and downs. Super useful, but they do go up and down a lot. Same for oil, for example, or gold. All these things are commodities that go down, up, and down a lot. And if you take a look at the max chart, you will see it all over the place. Take a look at how many times the stock has been going up and down, over here and here, or here and then here, up and down, then up and down and up and down and up, and again the same story, down and up, down and up, down and up, right? It's all over the place. It's happening all over the place. Why? Because it's a cyclical sector, a cyclical industry. And if you take a look at the 3-year, for example, you can see it happening again over here. And the 5-year, you will see it happening again a couple of times. And so these kinds of companies can really pay you well if you are patient. And this is how I handle those. Now I will tell you that regardless of what we're going to be seeing here in terms of the financials of the company, I will not be buying this company. The financials could be amazing, and as you can clearly see here, they sort of are amazing. But again, you have to remember that this company is not only about the financials, it's about the environment. And when I'm talking about the environment, I'm talking about the financial environment. I'm talking about cycles, financial cycles. And so I want to be buying this company where everybody else is selling it, whereas actually when actually steel is a commodity that nobody wants right now. This is when I want to be buying it. And this actually happened. It happened in 2020, and this is where I bought. I actually bought when the company was near $8 or so back in 2020, and I sold about 2 months ago when it was 25, 26, something of that sort. And as you can understand, I more than tripled my money. And so now you may be looking at this and be like, okay, now it's sitting at $27. Is that a buy? Now I wouldn't buy that, as I said. And if you take a look at, again, like the 5-year chart here, you will notice that you're having sort of like peaks near this 45 level here. And then the second peaks would be maybe near this 35 level. So you could potentially make a little bit of money here if you buy now and sell at 35 or maybe even 40. But it's not the best you can do in terms of risk and reward. So what you like to do with these companies is buy when the actual price is very low, when it's sitting around these levels, like 7 here or 5 here, maybe even over here, like 13, 16. This is when I would buy this one. Again, 5, 7. This is when I'm buying this, and this is when I bought it. But when it becomes a little bit too high, when it becomes close to 30, 35, 40, this is when we're entering this sort of like resistance levels, as you'll see. This is when previously the stock price started going down, and you will notice similarities. It tends to be at around 40, 35, in some cases maybe a little bit more, but it's sitting at a similar level, like $40 to $50 for the most part. And again, you could actually potentially buy right now and potentially drive it to 40 and then sell. But I don't like to play these companies this way. I want to buy them at a very subpar level when they're like 10, 12, 13, something of that sort, or less than that, as it was when I bought it, about $8. Now, if we examine the company financially, you will see that their P ratio is 1.58, price to free cash flow ratio 1.99, and all that. Increasing revenues, increasing net income. This is pretty good metrics to know about, because if the company enters a massive slump, it's good for them to have, for instance, cash at hand. it's good for them to be able to sustain potential issues that arise with not selling many, with not doing very well in terms of selling in a specific period of time. And so it pays to know what kind of debt the company has. For instance, you don't want a company that is overridden with debt, for example, when you are entering this kind of company. And you also want a company that has potentially some good cash at hand. Like you will see, this one has 2.6 over here, 2 billion pretty much. So they can sustain a little bit of a period of lesser productions and lesser gains, is the point that I'm trying to make here. And as you notice here, when the stock actually goes higher, the company's production tends to be better, and they're making better free cash flow as well. But in the previous year, again, a cyclical company that can go up and down a lot. And so this is why you want to be buying it when it's low, and then give it some time to reverse course, because the situation in cyclical companies is always like this. It's an up and down pretty much momentum that's going on. It's like a pendulum. And so the only thing that you can kind of take a little bit of a look here is the stock evaluation tool. But again, you kind of want to have sort of like a ceiling for when you buy here, because you can get a little bit confused by seeing these values here. If you take a look at the revenue growth, it can be all over the place. Again, very cyclical nature for a company. You can go low like 10, 12, and 14. And this is why it's important to know what kind of industry you are examining. And the net income margins here, you can go maybe something like 7, 8, and 10, let's just say. And the free cash flow margins of 50, 60, and 70 maybe. Actually, 50 here, 50, 60, and 70. And 13% is where we typically want to get. And now if you hit calculate here, you will see that you're getting low, medium, and high estimates that are way, way higher than the current price. But you really, really don't want to follow this through. Because again, remember, this is a very, very cyclical nature of a company, and the next year could be much, much worse than this year. And while we projected revenue growth of 10%, it could be way worse than this. Because again, it is a very, very cyclical company. And you will see we had years of 24% loss here, which could happen next year. And so you can't really go with a discounted cash flow model of that sort here, although it can tell you whether we are sitting at a cheap price right now based on what the company is making. So that's good to know for sure. But even though it's green, I wouldn't buy at this level myself. Again, remember this low here, $55, and now go back to the stock analysis chart. And if you go back to the stock analysis chart, and remember it was 55, you will see that 55 has been barely detected in the last 5 years. And so if you take a look at the max chart, how many times did we have something that's close to 55 here? You see that 60 has been a level that hasn't been seen so much apart from this period of time here, and that's many, many years ago. And this is why I wouldn't recommend going with just the discounted cash flow model when we're looking at cyclical companies, especially of this nature. You have to be a little bit more knowledgeable of the sector and of the industry and how it moves, and just avoid these potential pitfalls. Now, you could potentially buy this one and do well, and this could actually drive itself much, much higher, but you have to ask yourself, is it really worth the risk based on the price action that we have been seeing in the past? And if you ask me, I'd say no, there are better companies to have your money on for a long term, and this is not one of these companies to actually play for a long-term investment. It's a company to play for an up and down period and to try to profit through that and gain a percentage of your money, and then just let it rest, let it go back down, because it will go back down at some point, and then buy when it's much, much lower than today. That's how I'm playing these companies. Hope that video helps you a little bit. I think it can be very beneficial to know about these companies and how they generally act. They're not your typical companies, they're not your typical tech companies, a completely different story. You have to be a little bit cautious about how you handle these. And thank you for watching the video. I hope you enjoyed and you are having an awesome, awesome day. And in the meantime, take a look at this other video that I made earlier, and it discusses another subscriber suggested company, Smith & Wesson guns. And so you may want to watch this one as well, a very, very interesting video too. And thank you for watching this one again, and I'll see you soon. Bye bye.